So today, here we are on September. I don't even know what date it is. It's September 17th, 2024. And there was a big announcement yesterday, Mindy.
You've landed on the Mortgage Life podcast, where we strive to bring you mortgage-related info that's easy to understand.
We have conversations with market experts to bring you timely updates because there's one certainty in this industry: things change.
I'm Mindy Bodwin.
And I'm Pete Solomosi. Welcome to the Mortgage Life podcast.
It was a big and bold announcement, as we're reading in the media coverage.
Yes.
I've been a mortgage broker for 12 years, and the whole time the threshold for insured mortgages was up to $1 million. So if you purchased up to $999,999.99, you could get an insured mortgage, which meant that you didn't have to come up with a 20% down payment.
Right.
Obviously, over the past, especially the past few years, there's been an exponential price growth in Canada. So that $1 million threshold was a pretty awkward, like, okay, well, you can afford this, or you can save up an extra $100,000 and afford this. So anyways,
Right.
Good news. The threshold has been increased to 1.5 million now. So
very interesting. So that I think I want to back it up to the actual down payment. So like you said, at $999,999.99, your down payment would be $75,000 because it's 5% of the first 500, 10% of the next. So 75,000 on that amount. But if you go to $1 million, then it's 200,000. So it's quite a big jump. So this gives that relief for homes that are just above that threshold, and then, like you say, go up to $1.5 million. So we don't know exactly what the amount of the down payment is above $1 million, from $1 million to 1.5. It may still be the 10%. That's to come. But we do know that you can do an insured mortgage up to $1.5 million now. So that's cool.
yeah, it will definitely open the doors for more buyers. That $1 million threshold was a difficult margin for sure for a lot of shoppers over the past couple of years. So,
well, especially in markets like Victoria, Vancouver, and even in the Okanagan, there's a lot of homes that are starting to hit that $1 million mark. Because I think the benchmark price in Kelowna has exceeded $1 million for a detached home. So even that, as kind of an outlying area, that's a very high number. Like it's not a number that is far out there. It's actually the kind of middle home.
yeah, so I'm glad. It's about time, I would actually say. So this is a rule change that I feel like makes a lot of sense.
For sure. Well, and the important thing to note is that the last time that number was changed was, like Mindy said, when she started. So 2012 was actually the last time that number was changed. So it has been a while, and prices of properties and values of properties have certainly increased in that 12 years.
So that's good news story number one. We actually have two more good news stories today.
Indeed.
Good news story number two is the 30-year amortization. So Pete, if you want to explain, because this one isn't as broadly sweeping as the change in the CMHC insurance level. So if you want
Right.
to explain a little bit.
So it used to be that any insured mortgage would only max out at an amortization of 25 years. So they would essentially look at how long it would take to pay it off at the 25-year mark. That would be the determining factor in figuring out what your monthly payment would be. Now, there's two categories that will allow a person to get to a 30-year amortization, and that 30-year will drop the monthly payment because we're essentially amortizing it or paying it off over a longer period of time. So the two categories are if you're a first-time home buyer, and if you're buying a new build, so a newly constructed home. So
Right.
those two categories, yeah.
So this is an important distinction because when this rule was first announced yesterday, I actually missed this. So the 30-year AM for insured mortgages doesn't apply to all buyers. It's just buyers that are first-time homeowners or if you're buying a new build. So it doesn't matter if you're a first time home buyer buying your 10th house. If it's a new build, you can extend your amortization out. And so how is this helpful? Again, it helps with mortgage qualification. Prior to this rule change, if you had your 20% down payment, then we could extend the amortization to 30 years, which helped quite a few buyers with qualifying for that mortgage. But when we were looking at the insured mortgages, we had to scale it back to 25. So then adding the CMHC insurance premium onto that mortgage made those mortgages harder to qualify for. So this helps relieve that for, again, first-time home buyers or buyers of new builds.
Right. And there was another point in there that I really wanted to note, which is that, pause for dramatic effect. As you're talking, I lost it. I don't know.
One thing that I just thought of while you're thinking of that is just to be mindful that these changes don't actually come into effect until December 15th.
That's what I wanted to say.
Oh, good. See,
It's that it doesn't happen right away.
Yeah.
It's that we have to wait until December 15th, and that not all the details of this program are fully fleshed out. So we don't know exactly how this will all work, but we do know that it'll be December 15th. Thank you, Mindy, for that. And that some of the details are coming. So please stay tuned because we will update you when they come through.
Yes. So two good news story. And then Pete has a third to report on, which is very exciting. And it's something
Right.
I've been waiting for a few years now. So
it's crazy. We can go for months and not have good news stories in mortgages. And then all of a sudden we've got two in 2 days. The CPI numbers. So the inflation number came out yesterday and it was from the Bank of Canada. And they indicated that the inflation, the CPI number had dropped from 2.5% in July to 2% in August. That's a big yay. And the reason it's a big yay is because the Bank of Canada, their monetary policy, so when they move rates up and down, that was all in order to get the CPI number between 2 and 3%. And now we're at the lowest bound of that range. So they've accomplished what they want to accomplish. So Mindy, what is the effect of all this?
Well, I'm just going to pull out my crystal ball here.
Yes.
But
Mindy knows.
yeah, I mean, what this means is, like Pete said, that what they've been doing with the interest rate increases and now the sort of little adjustments downwards is that it's working. So there are some industry experts thinking that in the next interest rate announcement, which is October 23rd, the Bank of Canada might actually do a larger rate decrease. So they've been doing 0.25. They may actually do a 0.5, which is kind of a nice Christmas present.
Yeah.
Yeah. So, and the other interesting part that I like about this 2% indicator is that it also includes housing costs. So it seems like a catch-22 that as interest rates went up, housing got more expensive and the CPI went up, right? But now it's come down a little bit, but not like it really hasn't come down a lot. It's 1.5, right? But it's not dramatically affecting the housing. Like the cost of the housing has actually been coming down. I mean, the market's been slowing anyways. It's good news. Yeah.
It is good news. And it's one of those weird things when if you think about CPI and think about inflation, the price of bananas went up a lot, maybe 15, 20%, and that price kind of got built in. So the weird part is, and this is how you think of CPI, the price of bananas is not still continuing to elevate. It's kind of like plateaued. And that's like the same with gasoline and the same with bread and the same with beer. So like those things, they went up a lot, but now they've all kind of settled. And CPI is always a number that looks at year over year. So September to September or July to July. And so because those numbers have settled, the Bank of Canada has accomplished its thing. It's caused the prices to normalize. And so now that they're normalized, hopefully they'll start bringing things down. The big gift that we really were hoping to have was a few rate drops this year. And we've already had 3 quarter point rate drops. Now there's an opportunity and a possibility that we might get 2 additional rate drops, and they might actually be larger than a quarter point. So if If you've got a variable rate mortgage, HELOC, any sort of line of credit that actually works off of prime, you might be in for some good times ahead.
Yeah, some price relief,
Some price relief.
little bit of less stress watching the monthly cash flow, I would say.
Absolutely. So stay tuned. Listen to us. We're going to have more updates as things go on. And if you've got a mortgage coming up, now is a great time to discuss the opportunity of a variable rate or adjustable rate mortgage versus a fixed rate. Come chat with us.
Have a great day. This is The Mortgage Life.
We look forward to continuing the conversation.
So come back and listen.